Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, October 8th, 2024. Welcome back to the podcast, George.
Great to be back on as always.
Yeah, good to have you. And I guess I'll start just give our listeners a little bit of background. George, you recently published an update on your rates and Fed call following Friday's really solid employment report. As you and our listeners know, the number catalyzed a pretty outsized reaction, particularly in rates markets. Why don't we open the episode by going through some of the key points from your piece? More specifically, why don't we start by recapping your assessment of current labor market conditions in the US? As background, I know, and perhaps our listeners know, you've been suspect at some of the strength in the labor market data in particular. So I suppose the question here is, did this one strong employment report change your view?
Yeah, that's a great starting point, and I think it's been clear that one of our main macro themes has been this idea that the actual underlying health of the labor market is not as strong as the numbers have been suggesting. And then we had a number of revisions all throughout the last 18 months, and notably that big benchmark revision, the first take in August, the QCEW of over 800,000 adjustment for that one time frame. I think, as they say in our industry, as everyone knows, one number is not a trend. And especially a number that is potentially it has been impacted by a number of statistical anomalies that perhaps led to it being stronger from a headline perspective, as well as a couple of other things that were very unique. But even then, even if you start to kind of discount some of the strength, we're still talking about a broad-based, very healthy number with a lot of industries participating. Even though a lot of it was lower paying service jobs, it was still pretty broad-based. At least for the establishment number, it wasn't concentrated in one industry per se. So you can't deny it was a good report. Probably gets revised lower based on the statistical anomalies around the SA, NSA adjustments, and like the kind of big seasonal factor that really did not depress it as much. We can easily see 75,000, 100,000 revisions, and I would not be surprised. Still brings you back down to where the consensus would have been. The number was 254, but if you adjust it by 100 or so, you get back to the consensus, which was 150. But again, still not decelerating on the average trends of job growth. The issue in what we've seen in many other late cycle environments, and again, we could debate if it's late cycle or still mid cycle, you get these moments where there'll be a couple odd months where things look better than what the underlying trends are. And I think, again, because one number doesn't make a trend, I think the overarching cooling and decline in number of other metrics suggest that this was a one off. So we'll see. We'll see how that goes. It did remind the markets, at least, that sometimes we get too convinced of one direction or another, and I think it was a wake up call for a number of things to kind of reassess. But I do think that we'll look back and probably see these numbers revised, and that could then put the Fed further back in play. But we'll cross that bridge when we get there.
Yeah, I mean, certainly nothing is a straight line. And, my sort of, recollection of seeing a couple of, a few late economic cycles rather, is that the data gets pretty mixed. And it's really not obvious that you're in a downturn until afterwards. But, again, perhaps my own personal bias there. So, I think pretty clear you consider Friday's number only one data point. Doesn't seem like it's changed maybe your big picture view. That being said, I do believe that you adjusted some of your forecasts following the number. Why don't you take our listeners through those specific changes to the House call on the Fed and on your rates forecast?
Yes, and so we were one of the few, and most people I think will know that, at least our avid listeners, that we had that 50 basis point call, and as the first cut made a lot of sense, both as they should have cut in July. It's kind of a catch up. When you're behind on the curve, you should do more, not less. And so the first cut at 50 made sense. We thought that it should be followed by another 50. That was our prior house view. And even though I am a little bit skeptical of this being a turn in the labor data, you have to acknowledge it. And more importantly, you have to try to think about how does the Fed incorporate this into their thinking. And we've heard a number of Fed speakers, notably Chair Powell last week, really lean back on the idea that what's in their forecast, if the economy evolves along that path, that two more 25s makes more sense than another big 50. So we moved our view back to 25 basis points as the pace of future cuts by the Fed. The good thing in terms of like how we've been applying that across the yield curve and in general for those that have been following our work, we've we've always had a more of a dovish leaning tilt, which has paid off because rates have had more of a tendency to rally and come in lower than Fed funds. I mean, we've been trading the whole yield curve under Fed funds even while the Fed was hiking. And so our bias in terms of always having a much more shallower, lower path also means that when it comes to adjusting our long-term forecast, we really don't see drastic shifts. We try to not on purpose. I mean, obviously, if the facts change, we will change dramatically too. But our thesis hasn't really changed that much in the last 18 months, and therefore our volatility and our rate forecasts have actually been pretty low. So we don't really change things unless there's a need to. So the Fed call by moving out 25 basis points, we ended up just changing our 2 year and 5 year forecast somewhere between 15, 20 basis points, and which is, roughly in line as a beta adjustment. But we still end in 2025 at roughly the same levels of rates. It just that it gets dragged out a little bit longer as the Fed tries to aim for neutral. And so, yeah, that's something I think those that track our work will notice that we really didn't change our 10 year forecast because our view has always been that once we get into this easing cycle, it's going to be front end led, and that there's going to be limits to how much long term rates could rally because they already had rallied, and so there was going to be more two-way risk in long-term rates, and that along with the curve naturally starting to steepen, not in a straight line as well, but that should be the direction of travel should be steeper over time. That we thought it would be hard for 10 year to rally, so we didn't change our forecast on 10s or 30s because we're comfortable with them sitting somewhere around 4% plus or minus for the better part of the next year. We'll have rallies, we'll have sell-offs, and in the end, I think that most of the move will be front end driven. So we can, and plus concerns about who's going to be the next president and like their policies on fiscal will maybe lead to more treasuries. And so we've always had that kind of bias that long term rates won't rally like they used to in the past.
Yeah, so looking at it, looks like your end of this year forecast is 4 3/8 for Fed funds, relatively close to the forward. And then whereas your year-end forecast in 2025 is 2 7/8, which is below where the market, that part of the curve has gotten particularly hit over the last, week or so. So kind of to your point about your longer term forecast is staying little changed. So I think it's pretty clear the view. We had an event, the view evolved. That being said, there are a few key macro events in the very near term that could affect the view. This week, looking ahead, we have September FOMC meeting minutes, which could give us some interesting insight. Also have CPI and also PPI. So how could these particular events change your view and or, what should our listeners be mindful of as they navigate these events and potential uncertainty?
So, the one thing that in our piece, which we didn't have time to go through, but definitely recommend those that have access to our research to go look at it, is trying to understand like what are the potential buy zones, and we did a pretty deep dive into the the idea of like what are like max drawdowns during a easing cycle, and even if the Fed now is more of the mindset that they're normalizing rates, they're not necessarily looking to in part, easing into the economy. They're just taking rates from being very restrictive to less restrictive. They're still cutting rates, and so it's hard to see a massive sell-off in interest rates when the central bank is now in the process of lowering rates. So we went back and studied all of the prior easing cycles, and when rates are in a rally mode, they usually don't sell off for long periods of time, and these sort of big sell-offs that we get, which I would characterize the last week was pretty substantial. They end up being buying opportunities. Most people don't take advantage of that. We can see if this was enough of a dip or not, and I'll get to CPI and the Fed minutes in a second, which I think will play a role in that. But we did that deep dive of trying to understand every so often we're going to get sell-offs. They're a chance to reload, especially if you're of the same view as we have, which is that the Fed wants to get to neutral at a minimum, and that this is like a multi-stage process. A lot of the rally has happened, but as rates back up along the way, they give you a chance to kind of put on fixed income exposure. This week, these upcoming events could be the final kind of move that could result in another push higher in rates, and then test if we've exhausted this selling power, which then would lead to a turn in direction back down towards where we should be going, which is lower rates as the Fed's cutting. So if the minutes come out and suggest that the Fed was doing 50 basis points really as a one-time deal, that they were really just catching up, and it took a lot of persuasion to get towards a 50, and that their preference is 25. It's old news, but it still kind of takes away some of that dovishness that could have helped the market. So maybe that could result in a backup in rates. But I think it's really going to be CPI. We were going into NFP concerned that there was upside risks. I imagine it to be over 100,000, but there was the way that the seasonals and the way that the data was lining up, we were due for a bounce back in the jobs data. So we were completely surprised, even though the market moved more than what we thought. It was in the right direction, and we did get an upside surprise on NFP. There's a risk that CPI has a similar sort of outcome. So you're going to have two key events: NFP upside surprise pushes up rates, and then if we get another higher, hotter inflation reading at the end of the week, we might get another final push in rates. We'll see if that exhausts itself and ends up being like another great buying opportunity. So I think that's what lies ahead. And then we're going to be looking at a beeline towards the end of the month and the elections, which will take over from there.
Yeah, and this analysis you did on these drawdowns is pretty interesting. Just to kind of summarize the high points for the readers here, it looks like if you take an average of the longest episodes of those over the last, I don't know, what'd you do, 30 years, something like that.
40 years, yeah.
It's 40 years, yeah. So you've got, if and correct me if I'm wrong here, but you got a seven. They average a length of 7 days, and the average drawdown is 47 basis points. So I think we're at about 10 days and maybe 50 basis points. Is that right,
Yeah,
George?
yeah, we're at 4 to 5 days because these are business days, and yeah, and it's if we get towards CPI and we get another final push of like 5 to 10 basis points higher, I think we would be within like one of the biggest sell-offs in these environments and close to the average drawdowns, which were the most extreme during those cycles. Like typically in an easing cycle, sell-offs don't
Hmm.
last for 7 to 10 days. They're like 2 or 3 days, and they're like 15 basis points. So when you get up to like 50, over 40, that's starting to like present a buying opportunity.
Yeah, so perhaps this move is a little long in the tooth, and as you say, a buying opportunity. But I would encourage our listeners to check out the piece itself, so you can see the numbers and the analysis in front of you. Again, the piece is entitled "Rates and Fed Call Update Post Strong NFP Induced Shock." And if you are still not receiving George's strategy reports, check out the MUFG research portal at www.mufgresearch.com, where you can find all of your favorite MUFG research, as well as sign up to have it conveniently delivered to your inbox. Great stuff as always. Thanks, George.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.